Ladies and gentlemen, please welcome President and CEO of the Newport Beach Chamber of Commerce, Steve Rosansky.
Good morning, everyone. Or I don't know, maybe it's almost lunchtime, so good afternoon. As Jeff said, I'm Steve Rosansky, President and CEO of the Newport Beach Chamber of Commerce, and welcome to the Newport Beach Chamber of Commerce and the UCI Paul Merage School of Business 2022 Economic Forecast and Financial Outlook Luncheon. We have an exciting program for you today as we take a look at the economic forecast for 2022, as well as recent legislation and other developments affecting real property interests in California. So it's been about 2 years since our last economic forecast here at the Balboa Bay Resort. And when I think about all that has transpired over that time, it makes me think of the opening sentence of one of my favorite books, A Tale of Two Cities by Charles Dickens. And it goes like this: it was the best of times, it was the worst of times. It was the age of wisdom, and it was the age of foolishness. It was the epoch of belief, it was the epoch of incredulity. It was the season of light, and it was the season of darkness. It was the spring of hope, and it was the winter of despair. In many ways, America has been the tale of two economies. Some industries killed it, and some were killed. If you made electric bikes or boats or RVs, you couldn't sell them fast enough. If you sold cruise ship voyages or hotel rooms, you were still reeling from the havoc caused by the pandemic. Real estate brokers, they had a license to print money. Well, yeah, I wish I was still a real estate broker. While many others only avoided eviction from their apartments or foreclosure on their homes due to government moratoriums. Professionals and white-collar workers who could transition to work from home didn't miss a paycheck. While hairstylists, fitness trainers, and restaurant employees were whipsawed back and forth as their places of employment opened and closed with the rise and fall of the coronavirus. Some won the unemployment lottery, and they took home more in unemployment insurance benefits than they were making in their previous jobs, while less fortunate individuals couldn't keep up with mounting debt. It is with that backdrop that we bring you the 2022 Economic Forecast and Financial Outlook. As expected, at an event like this can only occur with the significant support of some very special sponsors. So please let me present our 2022 forecast sponsors. Our presenting sponsor, Wells Fargo Bank. Thank you. Our gold sponsors, the City of Newport Beach, City of Hope, Pacific Life, Spinnaker Investment Group, and Shop Off Realty Investments. Our silver sponsor, Kamauer Crampton Family Law. Our supporting sponsors are the UCI Paul Merage School of Business and the Center for Investment and Wealth Management. And I'd also like to thank Marina Dutton and the Balboa Bay Resort as one of our event hosts today, and of course, the Newport Beach Chamber of Commerce. Lastly, I want to thank our table sponsors. So probably, I'd say about 3/4 of the tables have been sponsored today. So thank you for supporting our program. And you can see their names in the back of your program on at your plate. Thank you. And also, I'd like to thank our Chamber Leadership Circle members. These companies support the Chamber at the highest level and help underwrite many of our programs and activities. So first off, we have the Balboa Bay Resort as a platinum member, Hoag Health Network, ACI Jet, Newport Beach Marriott Hotel and Spa, Newport Beach and Company, City of Hope, Orange County, and Simple Green. Our gold members are Picoco LLC, Wells Fargo Bank again, the Newport Beach Police Association, and Davies Locker. Our hearts are actually going out to Davies Locker with this oil spill. They're going to have a little bit of a problem coming up, so keep a good thought for them. I'd also like to thank all of our silver level leadership circle members, and those are listed on the back of your program. So I've already made a couple references to it, but as you know, this weekend we had a major offshore oil spill. that has dominated the headlines. And I thought it would be a good time to provide you an update on what is happening. So I've asked our mayor, Brad Avery, to provide an up-to-the-minute report. Brad, why don't you come up? He actually had the phone glued to his ear as he was walking in. I think he was on a conference call with probably some of the other cities and supervisor and all that. So Brad, let us know, exactly what's happening out there.
Thank you, Steve. Well, it's really hard to know exactly what's happening out there, and that's part of the problem. We don't control where the slick goes, and I will start off by just saying we've been very fortunate that for the past 4 days of this incident, the weather has been very calm. The sea has been flat, the wind has been very light, and the current is southerly, and all those factors have really enabled us to, I believe, dodge a bullet. And as oil on our beaches is never a good thing, but fortunately for us in Newport, it's comparatively light compared to what Huntington Beach has been seeing, and certainly what Bolsa Chica has been seeing. So, but for all of us that live in beach communities, this is just another reminder of the cost of having offshore oil platforms in our channel. And we all know Santa Barbara has had several significant spills. One of them, a major spill, over 1 million gallons, more than 50 years ago. And I think we're lucky to be where we are, considering that about 126,000 gallons of crude oil got to our ocean's surface and produced a very large slick. The City of Newport Beach is working closely with multiple agencies. We have been from the get-go, and the cleanup effort is part of a unified effort from the very top. The Coast Guard is managing this. The Coast Guard, along with the company that owns the oil rig, are working together to fully understand what occurred and working out how mitigation can effectively be achieved. So today there are 3 vessel task forces, 13 shoreline cleanup teams, and 8 on-the-water recovery vessels, and 3 Coast Guard vessels, and 3 aircraft, and 6 shoreline assessment teams working on the cleanup. In Newport Beach, there are 37 personnel deployed in the West Newport this morning to perform cleanup, and 8 personnel at the wedge. Officials from the State Fish and Wildlife Department have been monitoring wildlife impacts on our beaches yesterday and today. According to the Coast Guard's latest update, 4,788 gallons of oil have been recovered from the ocean so far by these recovery vessels. More than 5,000 feet of booms have been deployed along the mouths of the Bolsa Chica area and at our harbor and at Dana Point. The booms have also been deployed by the vessels at sea. The oil plume stretches from Huntington Beach to Dana Point. The current weather patterns make it difficult to predict where the oil will flow. In Newport Beach, we are seeing oil patches from Santa Ana River Jetty to the Wedge, with the highest concentration in West Newport and just south of the Newport Pier. No oil has been observed at Crystal Cove Beach. Newport Beach has an advisory in place advising residents and visitors to stay out of the water. This morning I got a telephone call from Admiral Brian Penoyer, and he's the Coast Guard commander for the 11th District, which is our whole district down here in Southern California. And he thanked the city for its proactive work to mitigate the impacts of this. And he also didn't directly say, but I could tell he was frustrated by his agency's outreach to us as a city to let us know kind of what they were up to, especially in terms of closing the harbor on a relatively short notice, which impacted some of our commercial boats and some people that were coming back from Catalina. And in yesterday's weather, had to take shelter, divert course, and go about 15 miles up the coast to get shelter at Huntington Harbor. The vessel activity can occur on Newport Harbor itself, so to the degree that our businesses can operate, certainly rental boats can operate within the harbor, people can recreate and enjoy our harbor, and it's being protected by booms right now. But for those businesses that Their livelihood depends on the ocean. Those are our whale watching businesses, our sport fishing businesses, mom and pop operations of all sizes. There's heavy impacts with this kind of closing. So we've got to think about those businesses and do what we can to make them whole when this emergency is over and we get down to getting people financially back in shape. So we've not observed any oil in the harbor other than small amounts that were brought in on boat hulls before the entrance channel closure. Also, the State Department of Fish and Wildlife has temporarily prohibited all fishing and collecting of shellfish, both recreational and commercial, from Huntington Beach south to Dana Point. So we're getting a lot of questions about how the public can help with the cleanup effort. And in short, we're asking members of the public to avoid assisting with the cleanup. It's more complicated than it first appears. There is a legal aspect to this where people involved in this kind of cleanup have to have at least 40 hours of training before they can engage in this rather toxic endeavor. So we're hoping to have more information soon about how volunteers can help without hindering the effort itself. We are also advising the public to avoid contact with any oiled wildlife. And this has been consistent messaging on all levels. If anyone encounters oiled wildlife, they are asked to call the Department of Fish and Wildlife hotline at 877-823-6926. As we push for cleanup resources, our city manager, Grace Leung, will be signing a declaration of a local emergency today. And this will need to be ratified by the City Council at our next meeting on Tuesday. And of course, our entire community is very concerned about the effects of this oil spill on our wildlife and natural resources. And as a boater, this affects me deeply and very personally. I was coming back from Catalina on Saturday and had dolphins on the bow of my boat, Galatea, and my nephews were on the bow watching this, and all of a sudden we were in the oil slick, and it changed the whole experience for my nephews. And it brought, I think, a good lesson for them about our challenges with protecting our environment and what we do with how we procure energy in the future. Of course, our entire community is behind the cleanup effort, and I assure you that the city, and as a part of the incident management team, we are doing everything we can to assist the cleanup effort, and we will try to limit the impacts on our beaches and wildlife as best we can. So thank you very much. I would like to also extend gratitude to the entire council who are all actively on this, and our city staff, and to our harbor master, Paul Blank, who has been absolutely fantastic in messaging to the council, to the city manager, what his team is seeing on our harbor and on our beaches out in the ocean. And certainly our lifeguards, fire department, Chief Boyle's team has been exceptional as well. So we're kept in the loop of what's actually happening all the time on our beaches and around our harbor mouth. And we'll get through this, and our beaches will be pristine in short order. Thank you very much.
Thank you, Brad. We're fortunate to have Brad as the mayor at this time. He's a lifelong seaman. He's was director, I think, over at the Orange Coast Sailing Center there on Mariners Mile in Newport Beach. And so we're in good hands with Brad and our city council. So I'm going to let you rest a little bit and enjoy your lunch, and we'll be back in a little bit later to start the forecast. Thank you. So as we get started, I'd like to introduce our two distinguished speakers today. So first off, we're going to have Christopher Schwartz. He's an associate professor of finance at UCI's Paul Merage School of Business. He also does double duty as the faculty director of the University of California Irvine Center for Investment and Wealth Management. So, Dean, I hope you're sending him two paychecks because he's got two titles, right? Okay. We also have with us our Community Development Director for the City of Newport Beach, Simone Georges. He's going to be talking about some, yeah? Okay, sure, Simone. Wow, you got some peeps in here that like you, Simone. You must be giving out a lot of building permits there at the counter. So just so you know how it's going to go, our speakers are going to make their two presentations first, and then we're going to handle the Q&A at the end. So please, if you have a good question, type it in notes into your phone or something so you don't forget it. I know I always do that myself. I go, I can't remember that question. But we'll field all those questions at the end. So with that said, let's get going. So Christopher Schwarz is an associate professor of finance at UC Irvine's Paul Merage School of Business, as well as the faculty director. Yeah, Paul Merage School of Business, all right, shout out. As well as the faculty director for the Center of Investment and Wealth Management. During his time at UCI, he has been published in all leading academic and practitioner finance journals. Is that true, Chris? All? No? He gave us this, so. His research has, I'm sure he has, he does a lot. His research has been cited in the New York Times, LA Times, Wall Street Journal, and the Financial Times, and he pops up on LinkedIn a lot too. I know a lot of people read him there. And he has provided a number of economic forecasts in the community. Prior to arriving at UCI, Christopher received his PhD from the University of Massachusetts at Amherst, during which he was also a visiting doctoral fellow at Yale University's International Center of Finance. He received his Bachelor of Science, I guess, from Babson College in Wellesley, Mass. Please welcome Christopher Schwarz.
Thanks for that introduction, Steve. Just a tip, it's probably not good to question the credentials of your speaker before he comes up on stage. It's okay. My mother said far worse, so don't worry about it. All right, well, I just have to say today's a big day for me. Today's finally a day I feel like an aging rock star, because it's weird. It feels like I never left. The audience is a little bit older, no offense, and so am I. But I think we're very, very profoundly to be back in person, aren't we? Isn't it great to be back here in person? Absolutely, absolutely. All right, so I enjoyed not seeing you on Zoom, so of course you could see me if you watch me on Zoom. I couldn't see you, but it's great to have all of you here. So just three quick thank yous. I got to thank the Newport Chamber, Steve and Jeff for putting this together. This is an amazing event, so really appreciate them. I want to thank everyone here from UCI, so a little zot out there, everyone UCI. And of course, especially my Center for Investment and Wealth Management board members who let us work and help financial literacy in the community. So thanks to all of them for all their support and helping do things like today's event. All right, so usually I start forecasts, and I like to kind of evaluate how I've done, right? So I tell you what I've done over, what I said last time, and then how I've done on my forecast. But obviously, I've given a lot of them over the last 2 years. I think we started doing monthly in March of 2020, and then we were doing them quarterly here at the end. And so just too much work for me. So I partnered with a local reputable news organization who took a look at my predictions and then reported back this week that 60% of the time, I've been right every time on my forecasts. So the good news is I think we've done a pretty good job. If you've been paying attention the last 18 months, I think we've navigated things pretty well. And of course, that's a great thing to do here. I'm glad we all could make it through the crisis well. Speaking of Anchorman, a lot of days I really do feel like Ron Burgundy right now, except for a couple months in 2020. It feels kind of like we've been coming to the same party for 12 years, right? I mean, ever since 2009, when we bottomed in the financial crisis, that was 12 years ago, by the way, everything's been good, right? If we look at the economy today, we had a tough 2 or 3 months again last year, but really if you look at the overall economy, the amount of stuff we create, so the real GDP as we call it, the amount of stuff we make is even higher than it was pre-COVID. So we've recovered all the way from what happened last year, we're above and beyond it now. And even if you look at the hardest hit industries, most of them are back 100% as well. So if you look at restaurants, you can see by and large they're close to back to 100% over they were in 2019. If you go ahead and you take a look at, say, travel, so this is TSA passengers, you can see that they're almost back, down about 20% still. That's probably business travel that's missing. If you look at gasoline demand and gasoline supply, you can see we're back where we were prior to COVID, right? So we're really coming back as an economy. We're in good shape. And so the question, of course, now becomes what's going to happen in 2022. All right, and so I always like to start with the Federal Reserve's forecast. The Federal Reserve, of course, has the most PhD economists in the entire country. They also have data to a lot of access to a lot of data I don't have, so I start there. And they think next year the economy is going to grow by 3.8%. So now this is the amount of stuff we're going to produce. This doesn't include inflation. They think we're going to grow at 3.8% next year. And for me, I mean, that seems, like a pretty big number, right? So if you look over the last 22 years, You can see that there's only been a couple of times where they forecast GDP to grow by 3.8% or higher. All right, so of course one of them was last year recovering from COVID. Otherwise, you have to go all the way back to the mid-2000s for a forecast that's high. And so people have been asking me about what do I think about that forecast? And I have to tell you honestly, I think that is very aggressive. That's my best impression of John Malkovich doing an impression of a Russian mobster. It is very, very aggressive. All right, it seems difficult for me to believe we're going to get that high, and I'm going to talk about why I think it's difficult for us to get that high, of course, over the next little bit of time here. All right, so the reason I think it's high is because kind of our economy right now is a little bit like Bob Wiley from What About Bob? How many people saw the movie What About Bob with Bill Murray? A few of you, okay, you guys got to watch it if you haven't. Our economy, it has problems. All right, we've got some problems, and I have to tell you, I've been here I got here about 9:30 this morning to get ready, and I've had 4 or 5 people ask me about the same question I'm going to talk about today. All right, so people, as an economist and as an economy, I think we've always been focused on demand. Right? We always worry about demand. You worry about whether or not people are going to buy your products. We worry about if consumers are going to buy stuff at Christmas. We worry about whether or not there's enough jobs for people. And so people are still kind of focused on that demand issue. And I'm going to show you, I really don't think we have a demand issue. Right? So what's going on first right now is our economy is starting to slow quite a bit over the third quarter here. Right? So if we look at the forecast for third quarter GDP from the Atlanta Fed, they do like a real-time forecast. It's down to 3.2%. Right? So how are we going to grow economy next year almost 4% if our economy is already slowing down to 3.2%, which by the way is a good growth number. I'm not picking on 3.2%. I'm just pointing out this is already lower than the 4% that people are talking about. All right, and a lot of you might be thinking, well, Chris, this is COVID, right? We had the Delta surge going on here. By the way, we had 400 people in a room and the Delta surge isn't over, right? So, maybe it's the Delta surge, and I really don't think so. Right, so if we go back to that restaurant and TSA data I showed you, you could probably draw a line around June. You could move it back to May a little bit or forward to July a little bit. But if you look to the right of the line, you'll notice that those lines really don't crash, right? They kind of squiggle along and go the same. The big spike you see at the end is Labor Day. Labor Day was on a different year than it was in 2019. And if I put the Delta surge on here, that's the blue line if it decides to pop up. Where's my blue line? There it is. All right, you can see the blue line, there's a huge Delta surge and really not much happened. Right, so I know a lot of people are focused on US COVID cases. What's going to happen to US COVID? All right, I don't know if there's an epsilon or a gamma or what's coming next, but unless something fundamentally changes with the effectiveness of the vaccines or something else, I don't really think COVID's the problem. All right, that's really not going to be our problem. The start of our problem really is that everybody's doing the Peter Gibbons, which is, I don't really like my job anymore, and I'm just not going to go. Right? This is pretty much the start of our problems, right? Seriously, it's everywhere. It's everywhere, right? And people are confused by this, right? I'm confused by this, right? I get the confused dog look every time because supposedly our unemployment rate is 5.2%, right? Which is about 1.5% higher than it was pre-COVID. So if you hear the Fed talk or you hear policy officials, they're talking about, oh, we got the soft labor market, we have to stimulate the economy because we got all these people out of jobs. And then I look at the JOLTS report. So the JOLTS report tells you how many open positions there are here in the United States, and our unfilled job rate is 7.2%. In other words, for every unemployed person, there's 1.4 jobs available, right? So we have this conundrum where we have an incredibly tight labor market, right? But we also have more people unemployed than people expect. All right, and so I try to think about, well, what would cause these issues, right? What would cause this mismatch between demand for labor and supply of labor, all right? And there's a lot of possible reasons. So these are some I came up with. I'm sure you could come up with some more. All right, so one is we have a mismatch between the skills of the people that are unemployed and people looking to hire them, right? So obviously, if you take some hospitality worker last year, they can't probably apply for a senior programming job at Google, right? So that's probably not gonna work out. All right, the second problem that you might possibly have is that people are in the wrong place, right? We've had a lot of migration from cities to suburbs, so it could be the jobs are in one place and the people are in another place. It could be people are staying unemployed because they're worried about COVID, right? So you can imagine older workers, if you're 60 or 65 years old, you don't want to go back to work because you're worried you're going to get COVID and you're going to die. All right, and the last one is that maybe we've made things a little bit too comfortable for people, and they just don't feel the need to go back to work, right? So we have rent moratoriums here that are just ending in California. If you make under a certain amount of money, the governor's going to pay it for you. We've had extra unemployment benefits, et cetera, and so people have had this argument, well, people are making more money by not being employed, and so they're just choosing to stay unemployed. All right, so I'm going to look at each one of these kind of quickly. All right, so this is, just to give you an example, this is leisure and hospitality. Right, so this is the number of employed persons in the United States in the leisure and hospitality industry. So we were about 17 million people before COVID hit. You can see we dropped down to 8.5 million, so literally half the jobs in leisure and hospitality disappeared in 2 or 3 months. And now you can see we're down about 1.8 million jobs from where we were, which, by the way, represents about 1/3 of our unemployment rate. Right, so if we got all these people back to work, that means our unemployment rate would only be about 3.5%, which is even lower than it was before we got to COVID. Now, if only I could magically wish that there was 1.8 open jobs in leisure and hospitality. Oh, wait, there's exactly 1.8 million open jobs in leisure and hospitality from the JOLTS report. Right, so you have jobs available, you have people that used to work there, and the question is, well, where are all the people gone? Right? Do they not want to work? Do they go to other places? So I was talking to the general manager here. She was mentioning that a lot of their employees are working at Amazon warehouses now, right? So you have this situation where you have missing jobs. But in any case, you know that there's people qualified for those 1.8 million jobs that are missing. They're just not going back to that job, right? So this idea that there's this huge mismatch between skills of people and the jobs open is probably not true. So this graph has a lot of dots on it. All right, so each one of these dots represents a state. All right, so on the horizontal axis there, I have the state's unemployment rates. On the vertical axis, I have the job opening rate for the state. So in theory, you'd want this line to be sloping vertical up to the top right, which means that the higher unemployment rate states have the most open jobs. You can see it's pretty flat here, so there's a little bit of a mismatch between where the jobs are and where the people are. It's not opposite, so it's not terrible, but certainly there's probably some circumstances where there's just not a lot of people in the right place to take those jobs. So for example, Billings, Montana has been very busy with new people. Of course, they don't have many people to start with there, and they probably don't have a lot of people to take those jobs, right? So maybe that's part of it. All right, what about older people who might be more susceptible to COVID being scared? All right, so if you look at employment by age, right, so this is various age brackets for employment. So 25 to 34, 35 to 44, 45 to 54, 55 plus. You can see there that middle age, 35 to 44 people have bounced back more than others, but you don't see a big difference between 25 and 34 and 55 plus. Right, so again, it doesn't seem to me like it's a scaredy thing of COVID that's keeping people away. And then the last one is hard to kind of figure out, right? There's a lot of things that go whether or not people stay unemployed or they're too comfortable. So the only real data point that we can use here is back in June, there's 12 states that decided to end their unemployment benefits early compared to everybody else. So I've separated those states out. Those are in orange, and then the states that kept going are in blue, and you can see after June they kept going down their unemployment rates. And people have talked a lot about, well, the benefits didn't matter. And so my comment to them would be, I don't think you can really tell anything from this. Right? Because I'm not a statistician, but those are not random samples, right? You can see the unemployment rate difference was huge. Of course, there's political views that are different, et cetera, right? So I don't really know the answer to that one, whether it's not too comfortable. Maybe that's part of the problem. But regardless of what the problem is, if we filled every single job that's open here in the United States, our unemployment rate would be minus 1.8%. Right? So it doesn't matter what you think the cause of the problem is. I'm going to guess skill mismatch is probably some of it, location mismatch is some of it. Probably some people feel good enough they don't have to work. Maybe they're trading cryptocurrencies or something and they feel good about life. Maybe they're dodging work. That could be it. All right, but oh, don't worry, they get worse. We got more time here. They get worse. We don't have enough people. All right, so everyone asks when are there going to be more workers, and my short answer coming up is probably not anytime soon. All right. All right, so we're out of people. But more generally speaking, I mean, I got to ask myself, where is everything? I mean, I look around for stuff, and it's like I'm looking for my car keys. All right, I can't find anything. All right, I had a friend that went out to match some paint. He had to go to 20 paint stores to find 1 gallon of paint to match. Right? It doesn't matter what you're looking for these days, it's hard to find. All right, because we're pretty much out of everything, right? So let's go ahead. We're out of cars. Right? We are out of cars. Right? Car sales are crashing. It's not because people don't want to buy a car, right? It's because we literally can't produce cars anymore. So in September, we're going to make 12 million cars per year, it looks like, when usually we sell 18 million cars, right? So we don't have any cars. Where the hell are the houses, right? Did COVID kill houses? I don't understand what happened here, right? Our housing inventory is half of what it used to be. You can see a bump down there for seasonality, but it's half of what it used to be. So where the hell are the houses? Where are the chips? We're out of chips, right? Nobody's got any chips anymore, right? There's no chips hanging around. So if you ordered a computer chip today from a fab somewhere around the world, it'd take you about half a year to get it. And by the way, it's getting worse, right? So the problem's getting worse, it's not getting better. All right, so we're just out of a lot of stuff. All right, and of course what happens when you're out of a lot of stuff and people want it, price goes up. All right, the price goes up. So wages are going up by 4.5% per year right now, which is the highest in the last decade. That's probably just where we're getting started. All right, I mean, I don't even know what to tell you about cars. Used car prices are 42% year over year. All right, so just a little statistic for you. I know some folks at Hyundai. So at Hyundai, when you used to return your car for a lease, how many people ever leased a car? Lots of people, right? You just show up and you return your car. You don't buy it out, you get another one. So 92% of cars used to be returned at the lease and they would just hand the car back. This year it's 7%. Because you can buy your car out and take it to CarMax and make thousands of bucks, right? Because used car prices have gone up so much, right? So you can see so our car prices are up. All right, of course, housing prices, wait for it. Wait for it, you know where I'm going with this, right? Yeah, they're through the roof, right? So their housing prices are through the roof, all right? You can see they're up 20% year over year, all right? Which, by the way, 20% is faster than any time during the housing bubble, all right? So just to give you some perspective there, it's fastest ever, all right? And so more generally, if we look at inflation in the economy, which a lot of people are worried about, all right, you can see here inflation in the economy is over 5%, which is the fastest it's been since the late 1990s. All right, we have inflation here in the United States, all right? And the reason we have inflation really isn't because demand is crazy. We have inflation in the United States because supply is not there. We do not have enough stuff to sell, right? It's not that we don't have, people are crazy demand. It's not like there's like millions of dollars just sitting around. People have money and there's just nothing to buy, right? And so we have inflation. What's going to happen here? All right, it's transitory, right? Right, no problem, it's transitory. By the way, I don't know if they have like a really good thesaurus at the Fed. I mean, this used to be temporary, right? We call this temporary, they want to see transitory. I think even the Fed's finally figured out that it's not transitory, right? In fact, Powell actually was testifying in front of Congress a couple days ago, and he actually talked about how he's very frustrated about the supply chain issues in the economy and how they can persist and like inflation's not coming down as much as he thought it would. All right, so inflation's going to be a problem for us the next year. Right, it's going to be a problem. All right, next thing we have to worry about is rents. All right, so this is rent data from apartmentlisting.com. All right, and this is from Zillow. So rents in the United States are up about 10% year over year. 1/3 of CPI is rent. All right, and it takes a long time for rent to hit CPI because people only renew their lease once a year. Right, so once rents start going up, it takes about a year for the total impact to hit CPI. So rents haven't even started to hit CPI yet, and we're already still at 5%. Right, so I think used cars will probably come down some, and rent will go up, and inflation is going to be pretty elevated next year. All right, so unfortunately, inflation's here to stay. All right, so how long do we have these supply issues? How long is it going to take us to get things back, and we don't have this inflation? I can tell the room's really sad right now. I can feel the sadness. There's no midterm. It's okay. No grade. It feels like I'm about to give out a test. All right. How long are the supply issues going to last? I got good news. They're only going to last you the rest of your life. All right? That's how long they're going to last you. Unfortunately, honestly, they're probably going to last a long time. All right? Because if you really think about how we built our economy, right? We have built ourselves an just-in-time inventory system, thank you, Walmart, plus a global supply chain, thank you, China. And you add in COVID, and you have havoc, right? So I want you to picture 3 years ago, or 4 years ago, or 5 years ago, you travel in the summer, right? You're on an airplane in the summer, and your flight gets canceled, all right? So I'm going to give you 3 choices. To get rebooked on a new flight in the middle of the summer, peak travel season, to take you 1 hour, 1 day, or several days before you get your next flight. How many people say 1 hour? Yeah, wow, you guys must be platinum or something. It takes a long time. All right, 1 day? How many multiple days they usually tell you it'll take you? Yeah, so it usually takes you multiple days because there's not many open seats. All right, and so we have this system where we have just enough supply to fill everything because we don't want to hold inventory because that's expensive, but that doesn't work out very well when your supply chain is not exactly robust. Right? And so everything is a problem, right? It's a problem to get everything, especially when the countries that we deal with have a zero COVID policy. See, everyone's focused on US COVID cases, but what happens when one person in a China factory gets COVID? What do? They shut it down, and that is the end of your supply chain. Because if you look at General Motors, they produce cars in 37 countries, they operate in 170 countries, their parts are supplied by 3,200 companies that have over 10,000 facilities, and a typical car has 14,000 parts. So what happens when a factory gets shut down in Malaysia because someone has one COVID case? That is the end of your car production. Next thing you know, you're like Michael Keaton in Gung Ho, where you're pretending that you're scratching off crap from a windshield that doesn't exist. By the way, I've had 3 people tell me they needed a new windshield, and they couldn't get a new windshield. So this is a true story, right? Windshields are hard to get. All right, we just can't expand the supply chain quickly, right? If you think about how you fix this problem, right, you either build redundancy, you build capacity, or you move things domestically. All those things take time and they're expensive, right? It takes time to build cargo ships. It takes about 3 years to build one of those huge cargo ships that's sitting outside in Long Beach right now. All right, it takes about 2 years to build a new factory that makes computer chips. Houses just don't pop out of anywhere. In fact, I was just talking to someone who's going to wait over a year for their new house. All right, houses just don't pop up. All right, so we have these supply chain issues, and they're going to take time to resolve. And until they get fixed, we're probably going to continue to see inflation here in our economy. Right? It's not transitory because the issues that exist are transitory, but they're transitory in a much longer time frame than the Fed would hope that they would be. All right. Last thing on supply, unfortunately, we're not getting any new people either, right? So this is our working age population in the United States, and you note it's going down at the end, right? It's actually going down at the end. So the number of people between the ages of 18 and 64 in the United States is actually declining. And you know, I'm not a biologist, but I believe it takes 22 years and 9 months to create another 22-year-old, all right, to enter our working age population. All right, so it's also going to take some time to fix that. All right, so that's unfortunate. All right, now, people, I've been doing COVID stuff, and people tell me, I'm not a virus person, so what do I know? But in any case, is Powell going to stop this? The answer is probably not. Right? So both the markets and the Fed says they're not going to raise rates until the end of the next year. By the way, it takes about 18 months for Fed policy to impact the economy, so this party is going to go on for another couple years probably, unless something radical happens. By the way, Jay Powell is up for renomination this year, so that'll make things very interesting to see what happens on the Fed. And of course, we know the word interesting is what you use when you don't have something good to say. All right, so in summary, I think 2020 is going to be a pretty good year, right? We're going to grow probably 2.5%, 3%, less than 3.8, but we're not going to have recession, we're going to get back to what we're used to. All right, we are going to have elevated inflation. 2% definitely, 3% probably. All right, people are talking about stagflation. Don't worry, you can keep your big collared shirts and your bell bottoms in the closet. All right, stagflation requires you to have very high unemployment, which obviously we're not going to have. All right, these supply issues are going to take some time to resolve. And the funny part about all this is we're very bad about estimating things. And my guess is we'll have too many fabs and we'll have too many cargo ships in 2024 when we do the forecast 3 years from now. Because we're going to probably invest in these areas. All right. So I got about 8 minutes to go or less, so let's talk about financial markets. The other day I was watching CNBC, and for a moment, I thought I put on Amazon streaming because it looked like I was watching Top Gun, man. Everything has gone vertical, all right? It's gone ballistic. It's crazy how great financial markets have done. So this is housing we already talked about. I mean, that's getting close to vertical, right? Right? So I show that to them, and of course the first word that comes out of their mouth is bubble, all right? So that's housing. Look at the NASDAQ. I mean, whew. That's total return on the NASDAQ versus the Dow Jones Industrial Average the last 30 years. That's pretty crazy, right? I mean, that baby's gone almost vertical. That's up 100% since last March, 100%. Anybody know when the last time the NASDAQ was up 100%? Prince was singing that song, 1999, all right? What could possibly go wrong, right? I mean, crypto, geez. That literally is vertical. Crypto is up 160,000% since 2013. It's only up 1,600% over the last year. Not too bad, right? If you bought some Dogecoin or whatever, as much as I mock it. And then, of course, I don't even know what to tell you about NTFs. I don't get it. All right, I just don't get it. Like someone paid $400 for a 52-minute video of farting. I can buy a can of Reef fried beans for $1.99 down at Albertsons. I can recreate that video, no problem. I don't get it. I don't get it. You know, and all this focus on digital stuff, non-tangible stuff, I mean, I have to be honest with you. I had to ask myself a lot of times getting ready for this forecast, what is the matrix? And am I in the matrix? You know, and did I accidentally take the blue pill and I'm still in the matrix? Or did I take the red pill and I'm in real life? Because I think people realize or think everything's Fortnite now. Like, people have not been outside so long that they forget we actually need like food and clothing and shelter and real life things to exist, right? And so when you think of things like the NASDAQ, which I think we all think about as technology, compared to, say, NYSE, which is boring stuff like food and clothes and everything else, I mean, it's crazy to think about the fact we focus so much on non-tangible things right now, right? We focus so much on non-tangible things and we don't focus on the things that we need. And of course, the last time the ratio was off by this much was, again, 1999, right? Because people are focusing on Netflix and not realizing you need a TV to watch Netflix, or you need a computer, or you need something else, right? All right, so just to be clear, all right, I want to spend the whole time on crypto I could, and on October 19th for UCI alum I will. Crypto doesn't meet any of the criteria for a currency, just to be clear. Crypto is not a financial asset because there's no future cash flows. Crypto is not a commodity because you don't use it to make anything. And so I guess that leaves it crypto may be a collectible. Hey, you guys want to see my crypto collection? It's right here. Isn't it pretty? I mean, everybody knows, what do you get collectibles for? You get them to show off, right? How can you show off your Bitcoin collection? You have to show them your phone. Hey, look at my Robinhood wallet. I mean, nobody cares, all right? All right, so just to be clear, right? And I know people are really excited about Bitcoin because El Salvador is using it, all right? So the first day El Salvador used crypto, they bought 200 tokens. I mean, that's going to be a game changer. And now they're mining it with a volcano. I mean, they made all of, what is it, 0.0059 Bitcoins with that volcano of theirs. All right, we got to get Tom Hanks to jump in that thing, I think. All right, so that's only $269. And now, I guess Ukraine, they're excited about Ukraine. The Ukraine? I mean, come on, everybody know out there that Ukraine it's feeble, it's weak. I mean, you're going to lose that game. By the way, that's a great Seinfeld episode. It's on Netflix if you haven't seen it when they play Risk. All right, everyone's excited about this stuff, and I don't know why. In any case, getting back to real financial markets, I mean, you get high and then you supply, right? I think that's right. No, get high on your own supply. Anyway, it's close. All right, so what are they doing here with crypto? When the price is high, you give the market, you give the people what they want, right? So you can see in 2013, there's only 10 million tokens. Now there's almost 90 million tokens, all right? So they're printing cryptocurrency like there's no tomorrow. By the way, when supply is unlimited, what's something worth? Zero. And by the way, almost all cryptocurrencies except for Bitcoin have unlimited supplies. So just remember that when people get excited. All right, of course, the equity market's no different. We had a record number of IPOs this year already, and we still have 3 months to go. You get high, and then you supply, right? We have almost 800 IPOs so far this year, way higher than we ever had during the tech bubble. All right, so we're definitely supplying with the market what they want. And of course, that's not particularly bullish for the markets. People keep telling me, Chris, the markets are in a bubble. I can't tell you how many times I've heard that the markets are in a bubble. All right, expensive does not mean that you're in a bubble. All right. Just like cheap does not mean that something is inexpensive, all right? So I remember my mom when, WorldCom went down to $10. She's like, Chris, WorldCom went down to $10. It's so cheap, it can't go, well, I mean, how low can it go? And I said about $10 more, right? Which it did. All right, just because something high doesn't mean it can't go higher, all right? And you can thank interest rates for everything seemingly being a bubble, but not. Right? Interest rates still are among the lowest we've ever had in our economy. And because interest rates are so low, that makes everything else very affordable. Right? Everyone thinks that housing is in a bubble. Oh my God, house pricing is so expensive, it's going to crash again. I got bad news for you. Housing is super affordable right now. I just blew your mind, didn't I? It's super affordable. Since the housing bubble in 2005, wages are up 60% since 2005. So that means housing prices go up 60%. And by the way, if you don't remember, interest rates in 2005 were 8%. Right? So what happens when you take 8% mortgage rates and turn them 3%? Anybody refinance their house? Absolutely, right? You get a lower payment or you can afford a bigger house. Right? And that's exactly what's happened. If you look at the stock market, if you look at PE ratios, price to earnings ratios that show you how expensive stocks are, right? If I showed you this to you, you would be freaking out right now, right? Oh my God, it's 1999, prices have never been higher, we're gonna crash, bad things are gonna happen. So this is based on past earnings. All right, if you look at future earnings, it's almost an all-time high as well. Oh my God, we're in a bubble, we're gonna crash. right? But if you compare stock prices and stock dividends to interest rates, you can see that we're pretty cheap, right? The reason that everything seems expensive is because you're looking at the wrong number. You're looking at price, but you're not looking at relative to the price of other financial assets. Right? That's what you have to pay attention to, right? Because once you index for the fact that, hey, mortgage rates are really low, people can afford houses, then it doesn't seem like you have a housing bubble because there's no mortgage debt problem, right? That's the thinking that you have to have. It's all about the price relative to interest rates. All right, the bad news, and now things are gonna get sad. All right, I'm sorry, I have to do this because Steve told me I had to do a forecast and I don't like to be wrong, all right? So this is a dot plot, and you can just pay attention to the red line here. So the price you pay for stocks is on the x-axis, and your future average 10-year return is on the y-axis. We have a PE ratio of 38 right now, which means that your expected return for the next 10 years, and this is nominal, by the way, is 3% per year, based on the old red line. You can see the red line does a pretty good job of figuring that out. All right, if you think about 60-40 portfolio, if you look at your bond portfolio, well, right now, if you look at the relationship between 10-year bond yield today and your 10-year average return on your bonds, you can see it's a pretty linear line right there, which makes sense. And at 1.5%, that means your expected return for the next 10 years is 1.5%. Things are expensive, not necessarily in a bubble, but it does mean that we're gonna have low returns going forward because you're paying a lot for everything, right? That's the way it's just gonna work. All right. Do I have anything to help you? I wish I had some things to help you. Unfortunately, Powerball was on last night, so I was going to give everyone a free Powerball ticket on your chair, but it won, so it doesn't work. All right, so maybe you want to get higher response. You want to go from like BBB corporate bonds, but you can see this is the spread, the extra yield you get for holding riskier bonds, and you can see it's also near an all-time low. All right, so financial assets are very expensive. The one thing that might make sense is gold. So this is a plot, a simplified plot. The black line is the relationship between PE and stocks I showed you before. You can see gold has the opposite, right? So as PE goes up, the value of gold tends to go up in the future. So maybe that's one thing you might want to think about. Please don't bother using international if you think you're going to diversify. Right, so this is returns of the UK, France, and the United States during the financial crisis blow up in our stock market, and you can see that all three of those lines look exactly the same, because if we stop buying stuff, that means that all other countries are hurting, right? Germans 50% export, so if we don't buy their cars, they're in trouble. All right, so unfortunately for you, we're not in a bubble probably, but we still probably have future low returns. That's an unfortunate thing, and if everything I just told you scares you, then there's places you can put your money here, which I'll show you in just a minute. So this is the last thing I want to talk about. I think I'm pretty close to time. And so just give me 1 second to explain this to you. All right, so if you think about your life, I want you to think about your lives for a moment. Everything's flashing here. When you're young, you are a consumer of capital. When you're young, right? You get student loans to go to college. You take out a mortgage to buy a house. You get money because you want to start a business. Right? You're a consumer of capital and you're borrowing money. When you're old, you are a provider of capital, right? You're paying down your mortgage. You're trying to save for retirement. You're selling your business, right? You're the person that becomes a supplier of capital. And so if you think about supply and demand, if you have a very young economy where everybody in this room is young, that means all of us are demanding capital and there's no one supplying it. Right? And simple economics says that means that the price of capital is high, which means, AK, you have high returns. All right, now imagine that all of you are 80 years old in this room, right, and nobody's young. Well, none of you are asking for capital, all you have it, and no one's demanding it, so the price of capital is very low. Right? So what you have here in the blue line, that is the ratio of young to old people here in the United States. In the orange line, you have the yield on the 10-year Treasury bond. This is from 1960 to 2020. Those things kind of seem to go together, don't they? All right, no, I don't have anything about inflation. I don't have anything about the Federal Reserve. I don't have anything about budget deficits. I don't have anything, right? Because fundamentally, the price of capital is based on supply and demand, right? And we're going to get older over the next 10 years. So as I know some of you think rates are going to go up a lot from here, and maybe they go up a little bit in the short term, but in the long term, rates are continue to go down, right? As our population on average gets older, right? So that's one to think about. All right, last thing to tell you here. If you're scared of everything I said, I got one piece of advice for you. Put your money in that air vent, all right? That's the place to put it, all right? Just watch out that it doesn't end up going to some dentist guy or who that doesn't want to pay his bills or whatever. I forgot what happened in the show. All right, Anyway, in conclusion, I think this year will be a good year for the economy. Not 3.8% good, but it'll be good. Higher inflation's here to stay. Not like stuff in your furnace money type of inflation from Germany in the 1920s, but we'll have higher inflation than we expect. Supply is going to be a limiting factor, and it's going to take us some time to fix. I think housing is going to be ridiculous for a little while longer because it takes time to build houses. And I think financial assets are probably not in a bubble. I don't think there's any reason to think they're going to crash this year, but also returns are probably pretty low going forward. Thank you so much. Thanks, Steve.
The man delivers, that's for sure. Thank you again, Chris. Excellent job. And don't forget, I did ask the dean for 2 paychecks, so, okay. I have to correct an error I made a little earlier. I forgot to introduce one of the most important people in the room, one of the most important VIPs. My sister, Robin Grant, is here. She just finished up on the Civil Service Board. I thought she resigned as of yesterday, but I think she's due until 5 o'clock today, so I should have introduced her as well. And she's also running for city council, so watch out for her. Okay, so let's move on to the second half of our program here. We have a very special guest speaker here. I work with him a lot over at the city. And that person is Simone Georges. And Simone has spent 28 years working in both the private and public sectors. He was selected as the Community Development Director for the City of Newport Beach in 2017, having previously served as the Chief Building Official. As Director, he oversees the divisions of planning, building, code enforcement, systems administration, and real property. He oversees a department of 60 dedicated and committed employees, some of which are here today, focusing on serving the community. His department processes permits of over $1.4 billion annually, and if you take a drive around Newport Beach, you know virtually every block has construction on it. Some have multiple construction, so keeping Simone and his staff very busy. Simone has a Bachelor of Science degree in Civil Engineering and is a licensed professional civil engineer, a licensed real estate broker, a licensed engineering contractor, and a certified building official. Please welcome Simone Georges.
Well, good afternoon and good evening, everybody. Again, I'm Simone Georges. Thank you to Steve Rosansky and the Chamber and the Balboa Bay Club, and thank you to all of you for being here. This is great. I mean, it's fantastic to all be here at once. It's been 2 years for me since I've been into an event like this. Isn't Chris great? He's such a great presenter, great speaker. He's such a hard act to follow, definitely. My son, who's in high school, took a class with him during the summertime, and I had no idea that Chris was actually going to teach his class, and my son loved it. He wants to do what Chris does, so congratulations to Chris. He's such a great presenter here. All right, I'm going to give you some more, I don't know if it's going to be good news or bad news, but some of you have heard this presentation before, and I want to talk about just housing in California, housing locally. One thing that's really interesting for California is that the California State Legislature, they're all in on housing. So have you seen that scene in the movie? And unfortunately, I don't have a clip of a movie here, but that scene of the movie where that gambler puts all their chips in and bets it all on a number or whatever that poker hand is. Well, here the state is the gambler, but also the state is the casino, the state is the pit boss, and the state is the dealer. They're putting all their chips into housing, and I'm going to tell you why. So we've talked about a little bit here with regards to the state, but the state has planned that the state of California is short 3.5 million housing units, right? Think about that number. That's a big, big number, 3.5 million housing units. And in Southern California alone, which includes the San Diego region too, the state is looking to plan for 1.3 million housing units. Now think about all those housing units. Where is that going to go, and how is that going to come online, and how are we going to build all those housing units? Well, let's talk about housing first. Why is housing important? Well, for jobs, you need your employees, and you want your employees to be living next to you, right? So it's important to have that workforce, and you see it in the big tech companies, Apple, Amazon. They're trying to relocate their next headquarters because it's that talent pool that they want to pull in. It's very important to have housing in your city, in the place of your work, so you can enjoy that short commute and work and play in that same community. It definitely provides that wealth creation. right? So you buy a house, you build up equity, there's a lot of startup money. Some people start small businesses. Sometimes you actually transfer that wealth to your heirs. So housing is an important industry, and we track it. As Chris, you've seen Chris kind of his slides there, tracking the housing development. But there are challenges to housing, right? The land cost, the development cost, the construction costs. You see all those barges out there in the waterfront waiting to get in. There's a lot of windows and doors that are just sitting on those barges. The supply chain's jammed up. You have your labor costs too. It's hard to find talent. I'm sure a lot of you have tried to do your remodeling throughout this last year through COVID, and it's been hard to find that general contractor, that subcontractor to come and build that housing. And housing, believe it or not, it is highly, highly regulated. It is one of the most highly regulated industries in California, right? You have all your state laws, your local laws, your environmental laws. Every step of the way to develop housing, it is challenging and difficult, and it's very, very costly. But let's look at a little bit of the California population. So here's the census data that we've taken, because our latest census has just come out. From 2010 to 2020, we've seen an annual growth of about 6%. It's pretty anemic. Texas is actually much higher than that, probably double than that. But still, population growth is good, right? Because you need that demand. You need the growing population to buy more stuff, go out to dinner, and do all those important things that generate the economy. But what we've seen of lately, and this is the California Department of Finance, they have a separate metric, and they're tracking the California population, and there's actually been a decrease in the California population by an equivalent 0.6%. Now, I'm going to ask the audience, how many of you know of anybody that has left the state of California for any reason? Oh my gosh. From my perspective here, it's half the audience have raised their hand, right? I know 3 families that left California for different reasons. One of them is tax, one of them is a job, and the other one is just retired out and just kind of done to California, and they wanted to leave. So we are seeing an exodus. We are seeing a migration. The press is saying it's not an exodus, it's not a migration. Things are expensive in California. People are questioning whether they're going to spend their retirement in California, right? And we're starting to see that population drop. Is it due to COVID? Is it just due to general cost of living? I don't know. We'll see as we go forward. So let's talk about, oh my gosh, the value did not show up. I'm so sorry. It showed up on my screen. So let's talk about the housing unit production there. So at the end where that error is, it's supposed to be 99,000 units. Right? So we're seeing housing production, about 100,000 units per year. They say of the 100,000 units, 20% are due to accessory dwelling units and junior accessory dwelling units. And I'll talk about what those are in a little bit. But we see about 100,000 units per year. Now in total, if you look at California housing units, I swear to God, never change the color on the data sheet, because now you get an error message. So if you look at our growth of housing units in California, you're looking at a kind of an average about 0.5% per year. Well, if you see our annual population going up about 0.6% and our housing production about 0.5%, it kind of matches. It's not too far off. It seems like it's about right. But California wants more housing units, right? If I'm producing 100,000 housing units per year and California is short 3.5 million housing units, well, how many years is it going to take to build the 3.5 million units? Well, it is going to be 35 years. And that's what California wants. California wants housing units. So let's try to understand why. You saw the graph earlier about the price of housing. And I'm going to disagree a little bit with Chris. I think housing's really, really expensive. Right, and this is the graph going back 20 years since our last recession, our last real estate crash, to what our cost of housing is now. And you see that line there, that trend line in the middle there. That's kind of our trend line, where we've spiked up above that trend line. I don't know about you, but I have a number of staff members that make good wage. They're professionals, dual income. They can't afford a house in Orange County. They cannot afford a house in Orange County. Is that completely insane? I mean, that is tough. It's tough for the workforce. It's tough for industry, right? And it is that spike up. And I think that what we're going to look at is continue to monitor interest rates as we go forward. If we're not going to see interest rate increase, then those housing prices are going to continue the way they are. as we've inflated assets throughout because of low interest rates, as soon as we start raising interest rates, these asset values are going to start to readjust. There is a trend line, and it always goes back to the trend line. Here's the average sales price of kind of the surrounding cities. Newport Beach at $3.2 million. Huntington Beach about 1.4. I didn't put Irvine in there. That's $1.7 million. I think what's really important with regards to housing, it's the affordability, right? So here is a table out of the California Association of Realtors. They track and monitor affordability. So on the far right, that red, 17%, that's Orange County. Only 17% families in Orange County can afford a medium income household, right? California is 23%. The national median is 50%. It is expensive to buy a house, right? Since 2012, the affordability has dropped from 39%, again, that was the bottom, and now we're at 17%. Let me ask the audience again, and not those of you that already own homes, are there anybody here that purchased their very first home this past year? Anybody, very first home? There's one. Congratulations, round of applause. There's two. Round of applause for those people. That is huge. That is huge, right? Only 17% of families in Orange County can afford a medium home. And yet you only got two in this audience that were able to purchase a home. Homes are very, very expensive. What is the lowest we've seen on affordability? It came down to 10%, right? About 2006, 2005, around there, that's when the affordability hit 10%. Then after that, we had our crash and our market correction. Of course, back then, people were buying homes that they shouldn't have bought, they couldn't afford. So that's kind of a little bit of background of just housing prices and affordability. And so what is the state doing? Well, the state has always mandated housing for cities, right? And they do that something called RHNA. And RHNA stands for Regional Housing Needs Allocation, right? So they've done that since 1969. The state has mandated cities plan for housing. Cities can't get away from housing. They have to plan for housing. Right, since '69, they've been mandating housing units for all the cities in California. Now, as for me, I work in a city government. My job is I have to comply with state law, and all cities in California, Orange County, we have to plan for housing units. So for Newport Beach, the city has to plan for 4,845 housing units. And these housing units goes in cycles. This is an 8-year cycle. We're gonna begin our cycle in 2022 to start that 8-year cycle. Of those housing units, all cities have to plan for very low income, right? Very low income, and moderate income. And that is a mandate from the state. And you're saying, well, how are you gonna put very low income housing units in Newport Beach when the average cost is $3.2 million? Very good question. Very good question. How are we going to do it? Well, you can't do it unless you subsidize the cost of construction, and cost of construction is through the roof. And so the only way you can do it is you do medium to high density, and a developer adds more moderate income units, or more above moderate income units, so market rate units on top of the very low income units. And they have to subsidize it. Somebody has to pay for those very low income units. And each city in California is gonna have to go through this exercise. And my job is to establish policies and programs to encourage very low-income housing units. If you look at the screen, that's a big, big number. And just to put things in context, Newport Beach permitted 95 very low-income housing units in the last 8 years. 95 we permitted. The state's telling us we got a plan for 1,400 very low-income housing units. And what is that medium income? Well, you see the income, it's based on a county average, and you adjust it on a percentage basis. And developers do build low-income units, but they need that market rate units to subsidize the cost of the very low-income units. Now, this is and that's just an 8-year cycle. We'll see what happens in 8 years from now. So you'll ask me, where are you gonna put these housing units, right? So on the screen there, you have those kind of that lavender colors. Those are potential sites for housing units. And you can see that we have some in the airport area, and we've planned Newport Center. I'm not telling you that we're gonna remove Fashion Island, remove our biggest retail center, and put housing units. But the city's providing the Irvine Company an opportunity to add housing units if that's what they choose to do. Again, the cities don't control the private markets. The private enterprise does. private business controls the private markets. But Irvine Company will have opportunity to build housing units if they choose to go in that direction. And when they build, and if they build housing units, it's going to have to be a mixture of market rate and low-income housing units. This is not something that the city wants to do. This is not something our city council wants to do. This is mandated by the state of California. We're being forced to do this. And all cities in California are being forced to do this and plan for affordable housing units. So I know not everybody here lives or works in Newport Beach, so these are the RENA units for your city. Combined, it is over 180,000 housing units that have to be planned for Orange County. That's a lot of housing units, right? We've never seen this much housing. This takes 40 years of organic growth to get this level of housing. But the state is forcing it amongst all the cities to plan for this much housing units. And again, these are giant, giant numbers. I mean, I hate to say it, but sometimes I say that these are obscene numbers. Cut these numbers in half and it's a lot. And now you double it, that's insane, the amount of housing units that all the cities have to plan for. Next slide. There we go. So the impacts on housing, right? You need services, you need police, fire. You know, you got the chief of fire here. I mean, he's going to throw up his hands like, what do you want me to do with all these housing units when those housing units come online? You need medical services. You know, what are the infrastructure demands with our roads and utilities? What about our schools? What's the impact of schools, our parks and library? And there's demand, you know, for any city, you want to have those food and beverage establishments, the retail centers that still need to be there to provide those kind of needs and services to your community. So I'm going to transition over to state housing laws, and this is going to be a really interesting presentation. So let's talk about the latest bills, SB 9 and SB 10, that was signed by the governor after the recall and chaptered. So basically, the SB 9 and SB 10 eliminate single-family zoning. Because of those two bills, single-family zoning is basically gone, right? And cities really have no choice but to follow law. So on the screen in front of you, that's your typical zoning. You got a house on a property, single-family zone, right? So very traditional. Well, in 2019, the state adopted a law that says you can build an accessory dwelling unit, and we used to call those granny flats. Sometimes you call them casitas up in the Palm Desert area. Well, no city can stop it. Every property owner here can build an ADU on site. You can convert your garage into a junior ADU if you wanted to. The city can't stop you. Of course, you have to get a permit. You need setbacks. You have height requirements. And your HOA cannot stop you. That's already law that was adopted in 2019. Well, if you like this, you're going to enjoy the next one. Now, under SB 9, you can build a duplex. You can add a full unit and still have your ADU and your junior ADU, right? That's kind of 4 units on a single-family lot, right? That's a lot. Now, those of you that own real estate, especially the new ones that just bought property, congratulations, because now you can add more density, add more value to your property. But what if you want to live in a quiet neighborhood and you're not looking for more traffic density or noise? You just kind of like the neighborhood that you live in. You don't have a choice, right? SB 9 allows you to add that second unit. Now you have a duplex. Wait, it actually gets better. Not only that, but you can split your lot in half, build a duplex on each property, and also add an ADU and a junior ADU, right? So you went from a single-family home to now you got a 4-plex on each property. So now you got 8 units. That's SB 9 for you. Again, if you own property, you're loving this, right? Because now your property is worth more. But if you are not looking to develop property, you just want to live in a nice community, you've lost that nice community, that private little quaint community. Now, one benefit is that cities can regulate the junior ADUs and the ADUs when you do your urban lot split. We don't have to allow it. Cities don't have to allow it. But what they do have to allow is the lot split and allowing you to build that duplex on each property. We're going to have a conversation with our city council shortly and talk about SB 9 and what does the council want to see going forward for Newport Beach. Isn't this great, people? This is fantastic. So what happens to your neighborhoods? Right now you got that lot split down the street, continue 10 years later, and now you got multiple family homes all throughout. And this is what California is really forcing throughout the city. So what is the potential for SB 9? How many properties, how many housing units can be developed just under SB 9 in Newport Beach? Close to 20,000 additional units, on top of the arena units, on top of the ADUs, on top of the JADUs. Local control is gone, the state has taken it away. And that's just how things are right now in California. What about parking? Well, you have to provide one space per unit, but there are exceptions. If you are within a half-mile walking distance from a transit corridor, you don't have to provide a parking space. So what is a transit corridor? Figure out where your bus stop is, measure it, your walking distance, that straight linear lines, and if you're within a half a mile, you really don't need to provide a parking space. Newport Beach has a coastal zone, so we're still trying to get clarity from the Coastal Commission. How do they look at SB 9? They may or may not require parking. But besides Newport Beach, there's a lot of cities outside the coastal zone, and you're not going to require the parking. Talk about SB 10. This is just one bill, one slide. It's very simple. SB 10 allows you to build a 10-unit apartment building on a single-family lot. SB 10 allows anybody to build a 10-unit apartment building on a single-family lot, but there's a but here. The city has to adopt an ordinance, and if they choose not to adopt an ordinance, this never happens. So, well, I don't think our city council in Newport Beach will go for something like this, but we're going to talk to them anyway. And if a city doesn't want to adopt it, then this never happens. If a neighbor city out in California wants to adopt this, then that's something that you'll start seeing. 10-unit apartment buildings on a single-family lot. I don't know, did I shock you? Did I scare you? Are you upset? SB 9, SB 10, it's interesting. There's no environmental review, there's no CEQA review, there's no public hearings. Public hearings are, I send a notice to the neighbor that says, hey, by the way, your neighbor's gonna split the lot and I'm gonna build a duplex. Do you wanna come and speak at the public hearing? Well, that's gone. We don't do that anymore. Those of you in development, coastal development permits, well, even though we issue a coastal development permit, there's no public hearing for that. And if there is a lack of affordability with all these laws, there's no affordability requirements, right? So these are all market rate units. So let me ask the audience, do you think any of this is going to create more affordable housing? Raise your hand if you say yes. Just got a sprinkling, just a sprinkling, right? It's going to be hard to see how this goes forward and whether there's going to be the labor or the materials to build all these units. All right, that wraps up my presentation, Steve. No good news.
So in conclusion, that's our forecast. Hopefully you learned something today that you can take back to your businesses and make some plans for 2022. I want to give a quick shout out to Wells Fargo Bank, our presenting sponsor. Thank you again, Wells Fargo. The Paul Merage School of Business, thank you for giving us Chris and supporting the event. Our event and table sponsors and our Leadership Circle members who I mentioned before. Again, the Balboa Bay Resort, thank you for hosting us here today and giving us a great meal and a great room to have our meeting in. I'd like to especially thank my staff at the Chamber, Jeff Parker and Amna, for helping me put this event together. Without them, couldn't do any of this. And I want to thank all of you in attendance today, because without you, we're not a Chamber of Commerce. And so I'll just conclude that we have another meeting on Thursday, so if you didn't get enough of the Chamber this week, come over to the Newport Beach Library about 7:30 in the morning. We have Assemblywoman Connie Petrie-Norris. She's going to give us a Sacramento update. Maybe you can ask her a little bit about why she voted for these two bills, SB 9 and SB 10. And in conclusion, just remember, if you're not now a member of the Newport Beach Chamber of Commerce, you should be. Come up and see me after the event. Thank you. Your valet parking is comped. Have a great week. Take care.